We're covering the Affordable Care Act's key consumer protections and the No Surprises Act for the health insurance licensing exam. First, the exam requires you to know that under the ACA, all individual and group health plans must be issued on a guaranteed issue basis. This means an insurer cannot deny coverage because of a pre-existing condition. It also means policies are guaranteed renewable and can only be canceled for specific reasons like non-payment of premium. An exam question might describe an applicant with a chronic illness. The correct answer will affirm that the insurer must offer them a policy. Next, the ACA eliminated lifetime and annual dollar limits on essential health benefits. If a question describes a patient who has incurred millions in covered medical expenses, the insurer cannot cap the payout. Another heavily tested topic is dependent coverage. The ACA allows children to remain on a parent's health plan until age 26. The exam will try to trick you with distractors like the child being married, not living with their parents, or having a job that offers insurance. None of these factors matter. As long as the child is under 26, they are eligible. The ACA also mandates that certain preventive care services be covered with no cost sharing. Now let's discuss the medical loss ratio, or MLR. This is a critical concept. The MLR rule requires insurance companies to spend a specific percentage of premium dollars on actual medical care and activities that improve healthcare quality. For individual and small group plans, this ratio is 80%. For large group plans, it's 85%. If an insurer fails to meet this target, they must issue a rebate to their policyholders. For example, a test question might state that an insurer in the small group market collected $10 million in premiums but only spent $7 million on medical claims. Since that's a 70% MLR, falling short of the 80% rule, the insurer must issue a rebate. A good way to remember this is the phrase, 80 for the little guys, 85 for the big guys, referring to small and large groups. Finally, we have the No Surprises Act. Its main purpose is to protect consumers from surprise medical bills when they unknowingly receive care from out-of-network providers. This applies to most emergency services and to non-emergency care from out-of-network providers at an in-network facility. A classic exam trap involves a patient who goes to an in-network hospital for surgery but receives a surprise bill from an out-of-network anesthesiologist. The No Surprises Act protects the patient in this situation. However, you must know what is not covered. The biggest exception the exam will test you on is ground ambulance services. They are not covered by the No Surprises Act. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's open